So you've gone ahead and actually bought some REIT stocks. They've either gone up or they've gone down. Should you sell when they're up 10% and dump your money in another stock? Or is there another optimum point where it's the right time to sell so you can maximize your gains and minimize your losses? Obviously, you don't want to be in this position where, you're holding for many, many years, getting all those juicy returns, and then bam, it's a crash and all your gains are wiped out because of the fact you missed out on the right opportunity to sell. Today we're going to be discussing the 5 rules of selling. As always guys, none of this is financial advice. Rule number 1, I want you to first take a look at yourself on one hand and look at all the information you have in front of you about that specific stock you're trying to sell. You have information from news articles, you have information from various analytical websites, and you have information from YouTube and social media. Company insiders not only know what you know, but they also know about the 3 to 5 year plan of the company. Some even know what's going to happen next month, if they're going to make an acquisition or not. With the insider knowledge, they can make a lot of interesting cases. They can either sell the stock so they can buy it at a later date, or they can indeed dump their positions because they think the company's not going to go anywhere in the near future, or they can even think it's not really a right time to do any action. So you get a lot of insight from just understanding what company insiders are doing. And I'll tell you a very, very easy way to find all this information. But before I tell you that, look at Equinox Inc. This is a REIT in the US. In the past 3 months, everybody in this company that I know of has been selling. Not a single person has flipped the switch and actually bought Equinox stock. This includes key company people like the CFO and other executives. This indicates that there's something going to go on in the company in the next 3 to 5 months or in the near short term, which is going to sink the stock, right? All it indicates that the company insiders think the stock is currently way overvalued than the company's actually worth. So they think, what the hell, why is this stock worth so much? This is crazy. Let me just dump all my positions. Now, how do you check this information from your home as a retail investor? Well, what you can do is go on a website called Simply Wall Street. This website will give you a free plan, and what you do, you sign up and you just type your company information in and you will get a nice overview of who's buying and selling in the company. You'll even get the names and you'll get a lot of other information as well. If a lot of insiders are selling the stock, you might be in a position to think, is it the right time for you to sell as well? Now that was rule number 1, insider activity. Number 2 is the fundamentals change. Now I don't want you to think fundamentals, this sounds a bit complex. No, this simply means if a certain news comes out about the company, a certain update, and it's a real shift in the company of what it was before. Now, a lot of people get this wrong. They sell on the news. This is completely wrong as well. What you need to understand is the update a permanent change or a temporary change, because there is a big difference. A temporary change will affect investor sentiment in the sense that investors will just sell off the stock and you will see a small dip in the company's share price. But if it's a temporary change, you've got nothing to be worried about. But a permanent change can shift the dynamics around the company. I'll give you a very good example of this. Now, Brexit meant that people thought that London property prices were going to tank. If I got this news at the time, how would I categorize this? I wouldn't say this as a permanent change to the stock, to the company. I would actually categorize this as a temporary change because, yes, in the short term, it's going to cause a lot of disruption. But in the long term, if the company has a strategy right, it's still going to be able to operate as usual. Second example I would like to give is a permanent change. Now, permanent change can mean, for example, the dividends the company was offering before is now no longer in effect. The company had decided to cut its dividends by a lot, and they're not in any mood to put this dividends back in the future. This is a permanent dividend drop. Now, in this example, you'll probably be wanting to sell your stock at this point because of the fact that if you're investing for income, which is a lot of people do when they're investing for REITs, you're going to be in a position to think, okay, I'm not going to get the income as I was getting before, so what's the point of me holding it? Now, this is a permanent change and you might want to sell at this point. So that was number 2 in the rules of selling, and that was if the fundamentals change. Now, my next rule of selling is what sent a company like Wirecard from €100 share to now a 10-cent share. If you had invested 10k at the time, it'll be worth around $100 today. Seriously, this is crazy. And this is what you call a fraud. Number 3 rule of selling: fraud or company mismanagement. This is serious stuff, guys, and it can seriously destroy your gains. And you might be thinking, oh, company mismanagement, how is that happening in the 21st century? Wirecard isn't an old tale, right? The Wirecard situation only happened in 2020. Wirecard was a payment processor in Germany, right? It's a very, very famous company, very big company. So a couple of insiders in the company were essentially siphoning off the funds to themselves or to another bank account, and this left a giant hole in a Wirecard's bank account. There was $1 billion missing or something like that. Obviously, this means that there's fraud being committed, and investors started to sell off straight away. Now, some people did hodl right at that point. They thought the company, there's no fraud. There's some odd news about the company. This is just gonna blow over. And now look, they've lost like nearly all their money. Now, if a news comes out about the company, don't ignore it. Take a look at the sources of the information and just see, does this sound legitimate or does it sound like a bit of a fraud? Watch YouTube videos on it if you will as well. Now, you will get a lot of news around a lot of companies, and some of them will be from short sellers. Short sellers are people that benefit from the company dropping its share price. Just like you're investing in a company where you're going to be making money when the share price goes up, short sellers make money in reverse. We're not going to go too deep into how they make money here, but the point is that you want to be checking the sources just in case the news is from a short seller who will obviously benefit from spreading false information around the company. Rule number 4 is indeed liquidating your investments for better opportunities. In other words, selling overhyped stocks. Now, you might be thinking, how do I know if a stock is overhyped? And the short answer is there is no way of definitely telling, but you do get a good idea if you're making the right decision. There could be obviously a scenario where you're selling and the stock goes up 5% afterwards after you sell. And yes, this stuff does happen, but because obviously the stock market isn't directly linked to the company's valuation. But as long as you know that, hold on a minute, this doesn't make sense, and you could put your money into something else, then it's a right call to make, in my opinion. So what you should do at the start when you're investing, set a target price of where you think the company is going to be in the near future. Now, this target price is going to be with something in mind. Either the company's revenue going to go up or something else is going to happen where it's going to reach the company's target price. Obviously, when you set this target price, you're going to have something in mind, right? You're going to be thinking, oh, if the company reaches X amount of revenue in the next year, then you think the stock price is going to go up this much. And obviously, this is not 100% accurate. By some means, it does give you a sense of whether the valuation of the company is correct or not. The second thing you can do is actually compare directly the company's valuation that you're investing in to other companies in the particular sector and see that, does the stock make sense? Does the stock price make sense? Or is the company indeed overvalued by a large margin? Many people have different views on this, and people think you should just keep hodling forever. However, this is poor investing. Back in the day, Cisco, a very big company in the IT sector, was trading at record highs during the dot-com boom. People that were hodling Cisco stock then were at least bag holding for like 15 years. The stock price never recovered to the all-time high levels. So it's important for you to understand, is the company trading at an all-time high, and is it at a right valuation or not before you sell? So that was rule number 4, selling overhyped stocks and liquidating for better opportunities. Rule number 5. During the past 2 years, society has been changing quite differently. You had people working from home. Property giants like British Land couldn't even pay its dividends because their tenants went bust, right? The tenants, the people that they were lending offices to, they went bust and they were not able to pay British Land. And society has obviously changed in a massive way where people are working from home. Now, this is a market trend change, and this is what you should consider for rule number 5. If, for example, in a weird event, trends have just completely changed against the company you're holding, you have to reconsider whether it's worth holding the company you are right now. As people are working from home a lot now, this market trend change has hit a lot of office REITs and shopping center REITs, because if people are working from home a lot, then what's the need for offices, right? Also, as the dividends you get from office center REITs are directly linked to the rent they are able to collect. If they're not able to collect any rents, then they can't pay you. And what is holding a REIT worth for income if you're not going to get any income out of it in the first place? So really consider whether the market trends have changed and whether they are in your favor, or this is going to be a bad hit for a very long time, and whether it's worth holding the stock throughout. So there you have it, folks. Although REITs have that property backing, making them solid investments over some hype growth stocks, it's very important to monitor your stocks and be a bit clever at selling at the right points. If you found this video useful, be sure to smash that like button. I really appreciate it, and I'll see you in the next one. Thank you so much for watching. Bye for now.